What we wanted to share with you is that gold at nearly 4,400 US dollars is not one market. It's a sovereign floor and a Western margin trading under the same ticker. And the repricing that carried it here ran from the top of the ownership stack. Trace the move, map the stack, and the same picture answers two questions at once. Why gold rose and how anyone from a central bank to a retail saver actually holds it. The gold price spent the first of the decade behaving like a commodity and the second half behaving like money. That sentence is the whole argument. When bullion cleared $4,000 an ounce and then printed a record of nearly $5,595 an ounce in late January, in 2026 itself, the reflex was to read it as a risk of spasm, a crisis trade to be faded. However, it was not. Hello, everyone. Welcome back to our channel and welcome back to the Capital Insights series. This series sits within our Fundamentals to the Noise series here at Punjab Capital Research. And today, following up on our yesterday's video on the global bond markets, we wanted to talk to you about gold. And essentially, we wanted to talk to you about the gold stack, the 2020 to 2026 repricing, and every layer of access from the central bank wants to the retail wallets. What we wanted to share with you is that gold at nearly 4,400 US dollars is not one market. It's a sovereign floor and a Western margin trading under the same ticker. And the repricing that carried it here ran from the top of the ownership stack. Trace the move, map the stack, and the same picture answers two questions at once. Why gold rose and how anyone from a central bank to a retail saver actually holds it. Let's do a deep dive on this very interesting and current topic. The gold price spent the first of the decade behaving like a commodity and the second half behaving like money. That sentence is the whole argument. When bullion cleared $4,000 an ounce and then printed a record of nearly $5,595 an ounce in late January, in 2026 itself, the reflex was to read it as a risk of spasm, a crisis trade to be faded. However, it was not. The move was a monetary repricing driven first by buyers who do not care what gold costs and only later chased by buyers who care about little else. Understanding that sequence, who bought, in what order, and through which instrument is the difference between treating gold as a position to be timed and treating it as a reserve to be held. This piece and this video does two things. It traces the 2020 to 2026 move as a sequence of distinct cohorts entering through the progressively more accessible layers of the market. And at the same time, it also maps those layers, the full stack of ways capital owns gold, from allocated metal in a sovereign vault to a token on a blockchain. The two are the same map read twice because the instrument that the cohort chooses tells you whether it is setting gold's floor or trading its froth. So essentially, the bottom line out here is that floor is sovereign policy driven and price insensitive. The froth is Western tactical and rate sensitive. The 2026 record was froth. The durable bid underneath is the floor. The stack is how you tell them apart. Trying to understand the repricing, we see that there are four legs, four cohorts, and this is what is behind the 2020 to 2026 repricing. Gold's advance was not a single trend. It was four distinct legs, each powered by a distinct owner entering through a different part of the stack. Read in order, they explain both the scale of the move and, more usefully, its durability. Let's talk about the leg one, which is the pandemic prologue, 2020 to 2022. The COVID shock did what crisis and zero rates always do to gold. It lifted bullion from roughly 1,500 US dollars in early 2020 to above 2,000 by that summer, as the Federal Reserve cut the floor and the fiscal support flooded the system. And then gold did the other thing that it always does, it consolidated. And it drifted within the 1,700 to a 1,900 band through 2021 and into 2022 as reinflation and then an aggressive hiking cycle raised the opportunity cost of holding a metal that yields nothing. And by late 2022, gold based around 1,800 US dollars. Nothing was unusual out here. Gold was still trading as a rates instrument, obediently inverse to the real yields. And then we come to the leg two, that is the central bank leg from 2022 to 2024. Then the anomaly began. Gold started rising when the US real rates were also rising, a combination that history says should suppress the price. What changed was not the rate math, but the reserve management calculus. The freezing of roughly 300 billion of Russian central bank assets after February of 2022 demonstrated Then dollar reserves could be switched off, and reserve managers responded by buying the one asset with no counterparty. Official sector demand ran above 300 tons a quarter across 5 consecutive quarters into the end of 2024, on the order of 1,000 tons a year, roughly double the prior decade's pace. This buying is policy, not a trade. It answers to the allocation targets, not the price targets, and so it does not flinch at a higher number. That is the demand floor that held gold up when the rate cycle said it should have fallen. And the first clear tell was that gold had begun trading as a reserve asset rather than a commodity. Bullion reached about 2,500 by mid 2024. And then we had the third leg, the inflow leg from 2024 to 2025. Private capital then stacked its bid on top of the sovereign one. A Fed pivot signaled the end of the hiking cycle. Exchange traded funds, which had bled metal for years, swung back to inflow and a run of catalysts: the US election, the April 2025 tariff shock, and a steady drumbeat of dollar debasement anxiety pulled Western investors in. Gold broke $3,000 for the first time in March of 2025 and pressed towards 3,865 by October. For the first time in the cycle, two bids were stacked in the same market: a structural sovereign slower and a cyclical Western inflow. And this brings us to the last leg, the fourth leg, the blow-off and the correction from late 2025 to 2026. The cyclical bid then went vertical. Western ETF buyers positioning for accelerating rate cuts drove gold from around 3,865 in October of 2025 to a record near 5,595 US dollars on 28th and 29th January 2026, a move of roughly 45% in just 4 months. Gold-backed ETF holdings hit all-time high of nearly 4,176 tons, and assets under management peaked at nearly 701 billion US dollars in February. Then the tape turned. Escalation in West Asia reintroduced an energy and inflation risk that changed the Fed's calculus from cutting towards holding. Real yields and the dollar firmed, and the cyclical layer unwound as fast as it had built. Gold corrected roughly 20% to around 4,000 US dollars by the end of June. However, the sovereign bid did not move. Through August, the recovery back towards 4,400 has been the structural floor reasserting itself while the tactical layer stays cautious. COMEX net longs nearly 542 tons and managed money close to neutral. So what can we say about the regime read? Gold has decoupled from the rate cycle at the floor, even as it remains sensitive to it at the margin. The 2026 drawdown was proof. ETF holders sold, and the central banks did not. One layer of the market answers to quarterly rebalancing, the other answers to decade-long mandates. That split is the entire investment case out here. And this brings us to the stack, the forms of gold and where they trade. Buying gold describes at least 8 different things, each with distinct cost, liquidity profile, and counterparty risk. The stack below runs from the metal that you want outright to the claims and proxies built on top of it. Read top to bottom, it trades ownership certainty for accessibility and leverage. The metal at the top has no counterparty, and every layer down adds an intermediary, a claim, or a new risk in exchange for cheaper, faster, and more capital-efficient access. Firstly, you have physical allocated, specific bars or coins held in your name and segregated in a vault, in a wholesale market, or in the London gold delivery bars. There is no credit or counterparty risk. You own the metal. The cost is the spread, storage, and insurance. This is the purest form of gold, and it's what serious reserve holders own. Secondly, you have the physical unallocated or pool, a claim on the bullion bank's general pool rather than on specific bars. It's cheaper and more liquid, but the holder is an unsecured creditor of the bank. Convenience bought with counterparty risk. This is the workhorse of the over-the-counter market. Thirdly, you have the hubs wherein the price is set. Most gold discovery and settlement runs through 3 venues, each with a different role. London, the LMB over-the-counter, wherein the wholesale allocated and the unallocated metal trades and the benchmark price is fixed. New York, COMEX, wherein the futures and options concentrate paper price discovery and hedging. And Shanghai, the SGA, the physical delivery gateway to the largest consumer market. Same metal, 3 ecosystems, and the plumbing that links them is the study in its own right. Fourthly, we have the paper derivatives, futures, options, forwards, and swaps. This layer offers leverage, capital efficiency, and precision hedging, and it is where the macro traders express a view. It conveys no metal unless the delivery is taken and the cost of margin and roll. It's also many multiples the size of the deliverable metal beneath it. Next in the stack are the exchange-traded funds, physically backed funds, the GLD, IAU, and more than 100 others globally. They hold allocated metal in a vault and deliver exposure inside an ordinary brokerage account. This is a bridge that brought the institutional and retail money into gold at scale, and it is precisely where the cyclical 2025 bid entered and the 2026 exit occurred. Synthetic swap-based products track the price via derivatives instead, trading physical backing for lower cost and added counterparty risks. Next in the stack are the miners, the equity proxy. Now, producer equities give leveraged, operationally geared exposure. You can get gold plus company risk, that is cost inflation, jurisdiction, management dilution, higher beta, but not the same asset. Next in the stack, we have the royalty and the streaming. Franco-Nevada, wheat precious metals, and royal gold finance miners in return for fixed cost cut of the future revenue or metal. Because their costs are fixed, a rising gold price flows almost straight to the margin, and their exposure is diversified across many miners. It is priced through the cycle compounding format, but it's still equity and still one step off the metal. And finally, in the stack, we have the digital and tokenized, basically gold-backed tokens. Tether Gold and Paxos Gold together hold roughly 9/10 of the market worth some 5 to 6 billion. They represent one vaulted troy ounce per token, transferable around the clock and usable on-chain collateral. They strip out some of the physical friction while adding issuer, custody, redemption rights, and regulatory questions. Small today, fastest growing by format, and a preview of gold as a collateral layer. And this brings us to the owners. Who holds which layer and why? The same metal is owned very differently depending on who is holding it. Map the cohorts onto this track and a pattern appears. The owners at the top hold the metal itself, set the floor, and the owners lower down hold the claim and proxies and set the margin. In terms of cohort, we can divide into central banks, hedge funds or macro funds, institutions and sovereign wealth funds, family offices, and the retail. Let's map the cohorts to the primary layer and the motive. In terms of cohort, we can divide into central banks, the hedge funds or the macro funds, the institutions and sovereign wealth funds, family offices, and finally we have retail. When we map these 5 cohorts onto the physical layer, for central banks, we have physical, allocated, and vaulted. For the hedge and the macro funds, we have futures, options, and ETFs. For the institutions and the sovereign wealth funds, we have allocated bullion, ETFs, and some miners. For family offices, it's mainly the vaulted, allocated, structured notes, and tokens. And when we're talking in terms of retail, that's coins, bars, ETFs, tokens, and jewelry. And when we're talking in terms of what they're actually buying, which is basically the motive, for central banks, it is a reserve with no counterparty, diversification from the dollar, insurance against sanctions, policy, not a trade. When we are talking in terms of the hedge funds or the macro funds, we have a tactical macro expression, real rates, dollar positioning, capital efficient, and the first cohort out at a time. When we are talking about the institutions as well as the sovereign wealth funds, it's basically a strategic diversifier or tail hedge for sovereign adjustment pools and a portfolio level reserve. For family offices, it's custody control, discretion and mobility, yield or protection wrappers on the gold reference. And finally, for retail, it's the accessible savings and adornment, the lowest barrier at the worst economics. So essentially, you can see that it's the same metal from the vault to the wallet, but the cohort sets the economics, the counterparty exposure, and the liquidity. Who owns which layer is not a detail, it's the signal. The layers that hold the metal set the price that persists, and the layers that hold the claim set the price that moves. The bottom line out here being that gold at $4,400 an ounce is a sovereign floor and a Western margin trading under one ticker. The 2022 to 2026 repricing was the floor rising the January record and the spring correction were the margin doing what the margin does. Dating the stack, who holds the metal and who holds the claim is what lets an allocator tell the two apart and size to the one that does not sell. That's all that we have for you in this episode of Capital Insights. Stay tuned in for our next one.